Welcome to Buy, Hold, Sell. My name's Jeremy Hook from TMS Capital. Joining me on the panel today is James Miller from Firetrail and Jelena Stevanovic from Platypus. We're looking at IPOs today, initial public offerings. Typically they excite the market, but not all are as simple as they seem. Recently, WeWork in the US and Lattitude Financial here, as well as Property Guru just recently, all been canned. So what's it saying about IPOs generally? And does it mean, James, going to you first, that we're getting a bit late in the cycle and floats are getting a bit ratty?
I think it's both the cycle and the markets right now. So if you look at equity markets around the world, valuation multiples are right up there compared with history, which is a natural function of lower risk-free rates around the world. But if you look at these companies that are coming to market, they're saying, that's a great opportunity, I want to get that multiple, but you've got to show us that you've got a sustainable path to earnings or path to cash flow so we can actually value you. So that quality really hasn't been there recently. The second thing I'll point out is that there's a big difference between IPO sell down and IPO raising for growth capital as well. And growth capital, we much prefer that one.
Okay, excellent. Jelena, do you agree, or is there something specific about these ones, or do we read more into the whole thing?
Look, as a general sign, we think that this is a signal that the markets are still functioning rationally, and that's a positive thing. I mean, generally speaking, aggressively priced IPOs are, often cited as a sign that the looming bear market, is ahead of us. The fact that we're not seeing excessive equity issuances either through, aggressive capital raise to fund silly M&A or very, very highly valued IPOs get away is a positive sign for equity market outlook, in my opinion. In particular, I mean, Lattitude, as one that you called out, that was a difficult IPO. The company attempted to list a couple of times at least, and through that process, we as investors got to see historical financial targets that would have been prospectus targets in earlier attempts. And we also got to see that those targets were missed, had it not been for some material one-off adjustments. All of that made it difficult, for that IPO to get away.
Just staying with you there on the issue of valuation. So WeWork started with a valuation of 47 billion. I think when it was last canned, it got to about 10 billion. Yes. Does this now say something about valuations in equity markets overall?
Look, I think the fact the valuations still matter is a positive sign. We're not seeing that exuberance in the equities market. That's typically a good sign. It's a sign that we might be late cycle, but not heading into bear market just yet. Yeah,
great. James, just coming back to your point and then looking at valuations, is there something you're looking at differently in an IPO to the stocks that are listed currently?
No, and not at all. Valuations have always mattered, and earnings have always mattered as well. Where I think a bit more focus has come on recently is we want to see those earnings in a company, whether they're loss-making now and will make money in the future. We want to be able to forecast them. So a company like WeWork, in private hands, it might have convinced its investors that it was changing the way we work and making these great co-working spaces. But when it came to equity markets, we were going to look at a company that was losing $1 billion a year, more than that, $50 billion of lease liabilities. And to be honest, it could be relatively easily replicated by competitors. So that scrutiny when you come to public markets...
Different level of scrutiny, isn't it?
Still there.
Yeah, good. Scrutiny of the Australian attempted float of Lattitude Financial. Do you think we can read anything into the state of the Australian consumer from that failure to get away?
Talking about the consumer is a broad term because there's bright spots and then there's weaker spots as well. And one thing I like to look at is new car sales. Yeah. There's been 16 consecutive months of year-on-year declines in new car sales. So that in by itself says things aren't that great, but you break up that data, luxury car sales are actually going all right, close to flat in recent months. So you can't make a broad brushed assumption about anything there. There are two things that I think will probably happen though that are pretty clear. Firstly, Sydney and Melbourne property prices. We've seen this before, property prices go up, more houses are listed, more houses are transacted, and then people buy more things to go inside those houses. So furniture, electrical goods, JB Hi-Fi, Harvey Norman, they'll be beneficiaries there.
Car sales are backward looking and the property sales are giving us more confidence.
Yeah, that's one way to think about it there.
Can you read in something broader in the macro sense here, Jelena?
Look, I'll come back to my original comment on Latitude. I think that particular business had difficulty with the equity market in particular, having tried to list multiple times. I wouldn't necessarily extrapolate across the consumer sector. I agree on the fact that domestic housing looks like it has bottomed, and a number of stocks exposed to that theme should benefit with a lag, but should benefit over time. On Latitude, again, I just think, given that it's essentially a consumer finance business, the proposed valuation metrics were simply too high for that nature of that business.
And did they try to spin the market to the buy now, pay later add-on icing on the top of the cake when the cake was maybe a big problem?
That was the unproven part of the business. We, that's a new venture, and to your point, as a listed investor, you want to see a little bit of track record, something to hang on to be able to forecast the dream.
Okay, now talking about dreams, IPOs, the average investor likes them. Have you found one in the last 12 months that you liked and invested?
Yeah, so in the last 12 months we have participated in Phineas Corporation Holdings. It's a software as a service provider to the insurance sector, in particular health, accident and life insurance. The company was started in 1993. Initially, in its first phase of its life, it focused on claims management software as a service. In more recent times, it had broadened that product portfolio to include things like billing, absence management, policy, etc. So going forward, forecasting the dream, we think the company can grow earnings through either selling more modules to existing customers, through adding new customers, through going into new geographies.
Okay.
Yep.
That's great. James, have you got a special for the viewers from the last 12 months?
I do, and there's some rationality in equity markets because we like Fineos
Wow,
as well.
there we go.
This is a company that's an exciting company, but it's in a really boring industry.
Yeah.
Correct.
It provides core system insurance software to companies that are really running on largely legacy systems, some that are over 20 years old. So Fineos can come in there, provide its cloud-based software. It's got a great management team. The founder's been around for years and years. It's worth about $800 million as a market cap, and we think it's got great growth potential.
Okay, so when you are looking at IPOs, founder-led businesses coming to market for the right reasons, maybe buy from governments or receivers, but be wary of private equity.